Hello, this is Jordan, and this video update is being recorded on the late evening of Friday, March 17th, 2017. Thank you for tuning into the video today. And in this video update, I'm going to be discussing the current short and medium term outlook for the gold stocks. I say current because things are always subject to change. And starting off, let's take a look at some other markets which obviously influence precious metals. And in this chart here, we have the daily candle charts of the US dollar index at the top, bonds in the middle, that's TLT, and then at the very bottom we have the 10-year yield. And essentially the short-term trends that are developing here should favor gold and gold stocks in the short term. Now the US dollar index, it couldn't get above 102 there, as we see in the last couple weeks. It failed twice at around 102. And earlier this week, I believe after the Fed day, it made a lower high. So we're talking very short term here, but if you look on the weekly chart, it looks worse. Now, some people are saying, this is a head and shoulders top, or this could be a major top in the U.S. dollar index. I don't buy that yet. I think at least in the short term, the dollar looks weak, probably going to go lower. I don't know how much longer this downtrend could last, this fledgling short-term downtrend. Now, as far as support, there's support at kind of 99, as you can see there, where the last two lows were. But I'm really focused on the confluence of the long-term moving averages, right in the mid-97 to 98 area. There you got the 200-day, which is at 98.28, the 400-day moving average at 97.45. That is a strong support target. So if we're right here and the dollar is going to go lower, I think that's a strong target where it could go to. And looking at bonds, as we can see there, potential double bottom in TLT and then a potential double top in the 10-year yield. But it's not a double tops and double bottoms are typically major patterns. These don't really look like major. I mean, it's major from the perspective of the very short term, but not something on the monthly chart, for example. But looking at TLT, I mean, we know that there's huge short positions on bonds. People have been talking about that for the last couple weeks, and they haven't gone away. And so based on that and based on the fact that we see the Fed hike again, but bonds are, based on TLT, they're starting to rally. They didn't make a lower low, and the same thing with the 10-year yield. It did not make a higher high. It peaked there around 2.60%. Closed the week at about 250. I heard Jeff Gunlock on TV said he thinks it's going to go to 230. I agree with that. So lower yields, higher bonds, that should support precious metals in the short term. Now the question is how far can the precious metals sector move based on that? The last video we did here on the Palisade channel, and we talked about a 15 to 20% pullback in February, and we got a little bit more than that. I still think that overall for the year we're kind of in a grinding process. We're in a range-bound market until the miners take out the February highs. That's going to continue to be the case. And one thing that bothers me about these charts is just look at the 200-day moving average. I mean, it was resistance in February, and it's kind of flatlining in the market since last August. I mean, it was trading above the moving average and it was trading below it. I mean, GDXJ went above it for a little bit. I mean, that is typically what you see in a perhaps a trendless market. I mean, a market that's going sideways, and it's really difficult because there's no real trend. Now we'll talk about the very big picture, I think, in the next slide, but here and now, with respect to GDXJ, I mean, you have resistance at 40, the highs around 42. GDXJ closed at 36.28. Now, it needs to remain above 36, in my opinion, if it's going to get up to 40 and go a little bit higher. I mean, my guess here, I think, there's a couple options, but my guess is I'd be a little surprised if GDXJ was able to get above 40. I think it can get to 40. I think we can see some more buying, but I'm skeptical that it can make it all the way up to 42. GDX looks better. It hasn't seen as much selling the last couple days. 22 is the key level for GDX. As long as it holds above that, I think it can get to 24. But in short, what we really want to see here is we want to see miners rally and get up to the February highs, at least get back up to the February highs. Because if they don't, and this rally peters out before the miners get to the February highs, it's just more evidence that we continue to be stuck in a range-bound market. And so the onus is on the bulls to at least get it up to the February highs. And we're still in a range-bound market until we break above the February highs. It would just, if we get up to the February highs, then I would give the advantage to the bullish case. Now, looking at the big picture, I mean, we can see that the miners have been in, or they are in, a major multi-year bottoming type basing pattern here that dates back. I mean, we're in the 5th year of this, or we've been 1, 2, 3, 4. 4 years. I'm having trouble counting here, but I mean, this is a multi-year bottoming pattern, and when miners eventually come up out of this and break out, we're going to see an explosive move higher. Now, my thinking, based on my work, is that that the move up to the major resistance and the eventual breakout is going to start later in the year, and the actual breakout will occur at the end of this year or early next year. But as I said at the beginning of the video, I mean, everything is subject to change. Now, another reason miners should rally in the short term, they've held the 80-week moving average, GDX especially, tested it. I mean, I like that action. And so based on that, we should see a little bounce. I mean, you see the same chart as me here. It would be, now I think there's more resistance. You can see the double lines, which for GDXJ are going across at 42, 43, and for GDX are right around 26.5, maybe 27. That's stronger resistance than the 2016 highs. And so that's what I'm saying. I want to see the market rally and get up to that resistance, because I mean, that would really show quite a bit of strength, considering October we had a weak rally up to that and then sold off heavily after the election, but we came back, rallied back up to that point. So if we can rally up to that point again, it's just a sign that the market is gaining strength and is closer than not to, I mean, getting above that resistance and testing the highs. But one reason why these lows that we've seen just over the last week or 2 weeks ago, I should say, one reason we want to see the miners hold above those, because those are around the 50% retracement from the huge move in 2016. And so if the market over the next several months can hold above the recent lows, I mean, that would be, again, another positive sign. So there you go. I mean, it remains to be seen what's going to happen, but I think we're going to rally here. Can we get back to the strong resistance at 42 to 43, 26, 27 for GDX? I'm a little skeptical, but we'll see. I still think that we're going to remain range bound with obviously bias over the next week or two to the upside. But again, I don't need to say any more. I've said a lot already. Now, this chart shows housing and banks, and what I'm focused on and what I've highlighted is the 2010 to 2011 period, because I'm seeing not a lot, but several similarities between the banks and housing and their action 2009 to 2011. And the gold stocks right now, I mean, the similarities, banks and housing were in horrible bear markets. I mean, really the worst bear markets since the Great Depression. I mean, the second worst bear market probably in the past 120 years perhaps. So you had the horrible bear market. I mean, both these sectors were down over 80%. Then you had a strong rise from 2009 to 2010. But then banks and housing, the correction after that first move, I mean, call it a wave two, their corrections lasted 17, 18 months in terms of time. And they retraced at least 62% of the previous move. In the case of banks, they retraced, I think, about 70%. And so that's very similar to what's going on with the gold stocks, because they had a big recovery, but it only lasted 6 or 7 months. And right now, I believe we're in the 8th month of this correction that started last summer. And so if that continues for another 4, 5, 6 months, or 2, 3, 4, 5 months, whatever, I mean, then the correction in terms of time is already longer than the first move up. And as I said, I mean, I think it's going to continue for several more months. And if you look at where the lows were in December, they were right around the 62% retracement. I think they might have gone a tick below in the case of GDX. So those are several similarities between these two markets. And the last thing I want to point out is the C leg down, which you can see that for housing and banks. Just look at where C and where that bottom was. Now, those markets broke. I mean, I drew the horizontal line there. Those markets broke support. I mean, that was a pretty serious technical breakdown in the summer of 2011. I mean, technicians would look at that. They'd say, oh, this is a major breakdown. You got to get out. It's going to retest the lows. But then suddenly they turned around and they shot so much higher in the next 12 to 18 months. Now, if gold stocks weaken in the months ahead, I mean, if they consolidate but they have a bearish bias and kind of slip and weaken, this is something we have to keep in mind. Because remember, at the January 2016 low, this is the most oversold gold stocks have ever been, in my opinion. I mean, at least in the last 90 years. Worst bear market in the last 90 years. I mean, I don't need to repeat all the factors why they were the most oversold ever. You know, perhaps the buying opportunity of a lifetime. But given all those things, it just tells you that, I mean, when you make a significant bottom like that, there's not enough sellers to drive the market down to those lows again. There's just not. So if gold stocks weaken and they, go to the December lows, or even if they trade a little bit below those lows, I mean, some people will look at that, they'll say, oh, it's a breakdown, selling, we're in a bear market. In my opinion, that is exactly the wrong take on that situation. You would be falling into a huge bear trap. And I mean, look here, you can just see this example. It happened with housing and banks. So this is just something to keep in mind if we see the gold stocks struggle in the months ahead. Now, that's all for this video. Again, you can follow all my work at thedailygold.com. Opt in there for my free newsletter. I send out a weekly update every Sunday, and that includes my most recent thoughts on the sector and some snippets from my premium update, which goes out the evening before. Thank you so much for listening and watching to this video. I hope you got something out of it. Let me know your feedback in the comment section. And if you have any more comments or questions, you can email me, jordan@thedailygold.com. Thank you so much for tuning in, and I'll have another update for you guys in the next week or two.